Okay. All right. So basically, this next question is just asking if each company spent $319,800 at the beginning of the current year for additional developed technology. Because of its proprietary nature, the technology is estimated to have no residual value at the end of its estimated life. Okay? So it's not going to be worth anything. So they're just asking you to calculate the impact that the amortization of each expenditure would have on the company's income statements. So all we're doing here is we're taking that 319.8, we're dividing by 3.9 to get to the 82,000. Then we're taking the 319.8 divided by 4.1 to get to the 78,000, and the 319.8 divided by 2 to get to the 159.9. So you can see that, let's assume that these companies were direct competitors and they're developing their version of these different developed technologies. You can see that Travelmore is going to have a much lower net income, right? Because they're using a much shorter amortization period. So basically, if you're looking at these three, again, assuming that they are competitors, who would you assume is doing worse? Travelmore, right? Because their amortization is going to be much higher than the other two. But this is where, when you're looking at the initial financial statements, right, we're looking at the income statement and we're looking at Travelmore and we're like, wow, Travelmore's not doing too good. But then you stop, and that's the reason why you go to the footnotes, because in the footnotes, all of this information right here is going to be disclosed in the footnotes. And then that gives you the ability to say, oh, well, Travelmore is amortizing on a much shorter time period. Okay? Any questions there? Okay. All right. Do we capitalize or expense? All right. Okay. So look at what we've got going on here. We got American Golf Corporation operates golf courses throughout the country. All right, so we purchased a golf course in Orange County. What do you think? Capitalize or expense? Capitalize. It's a big golf course. 2, we paid landscaping company to clear 100 acres of land on which to build a new course. What are we going to do? Capitalize it. The big thing here is that we're clearing 100 acres of land which we're going to build a new course on. You can't build the new course without clearing the land. Therefore, that whole clearing of the course is part of the capitalized cost of the course. All right, number 3, we paid a landscaping company to apply fertilizer to the fairways on its Coyote Hills golf course. Good. Expense, right? Just a little maintenance action there. We hired a building maintenance company to build a 2,000 square foot addition onto a clubhouse. Capitalize. Number 5, we hired a building maintenance company to replace the locks on a clubhouse and equipment shed. Expense. Number 6, paid an advertising company to create a campaign to build goodwill. Expense. Good. Okay. Any questions there? Just be able to, that is a perfect opportunity for something like a multiple choice question, right? Just make sure that you can determine between capitalizing or expensing, okay? And then there's another one. Let's see, what else? The only thing that I see on this one that is very, very different is number 1. It just says purchased a machine, $70,000, gave a long-term note. Again, the whole thing about the note, don't let that throw you off. That's just how they're paying for it. The other thing is number 7, where it says we paid $16,000 for extraordinary repairs. When you see that word extraordinary, that means overhaul, something, you know, is not going to function without this additional investment. All right. Same kind of thing here for each of the long-lived assets. Select its nature and related cost allocation concept. So it's either depreciation, amortization, or none. Okay. So on the trademark, notice it says no cost allocation. On this one, and let's see, this one is an intangible on the trademark. Make sure that we haven't talked about a ton of these, but make sure that you go back and look at the slide deck. It has a really nice layout of what kind of asset is it tangible or an intangible, and what is the amortization method, if anything. And then on the property, remember we've talked about this numerous times. With land, there is no allocation concept. Now, let's talk about this trademark thing. The trademark, remember trademarks, that's like a Clemson Tire Paw, McDonald's Arches, a Nike Swoosh, all those kinds of things that we don't allocate them, but we do impairment test them. So there is no allocation method, but we are looking at it because, again, right now, does the possible trademark for Tylenol need to be impairment tested this year? Probably. Okay. We're picking on Tylenol today. Sorry. All right, we got 3 different intangible assets. All right, so let's take a look at what we've got here. We got Bluestone Company had 3 intangible assets at the end of the current year. All right, we got a patent, we got a trademark, and we got computer licensing rights. Okay, now the patent, remember a patent, it's good for a certain length of time, so it makes sense that we actually allocated or amortize those expenses over the life. Remember the trademark, we just talked about that. We're going to impairment test it, but we're not going to allocate it. And then the computer licensing rights, think of the computer licensing rights as like a prepaid asset, right? We're going to use up a little bit of those licensing rights. So again, don't miss this. A licensing right is like you bought, I don't know, $2,400 for the licensing rights for Microsoft 365 for X number of years, right? At the end, we're talking about nothing left. So they're talking about computing the acquisition cost of each intangible asset. I don't think there's anything extraordinary in there. Those ought to be gimmies based on the information that they're given. Then they've got compute the amortization of each intangible for the current year. So the big thing is on the patent, right? It was an estimated life of 15 years. We bought it on January 1, so we're going to need a full year's worth of amortization on that one. And then the computer licensing rights were also purchased on January 1, and we're going to need a full year of that based on a 5-year life. Okay, so those two should be pretty straightforward there. Then it says show how these assets and related expenses should be reported on the income statement for the current year. Again, we've just got a total. Remember, the expense account, we throw all the amortization into one account, all the depreciation into one account. Where we break it out is the accumulated depreciation and amortization. So there is the income statement, and here is the balance sheet. All right. Any questions? All right. All right, we're getting close. All right, the asset turnover ratio. So again, remember on this asset turnover ratio, this is another one that it's like, be careful on this one when you are calculating it because it looks deceptively simple. Net sales, remember, net sales is now going to be a calculated number, right? We've got total sales minus returns and allowances minus discounts to get to net sales. And then the average net fixed assets, we're going to start with total acquisition cost minus accumulated depreciation at the beginning of the year for net assets, and then total acquisition cost minus accumulated depreciation at the end of the year, and then add those two numbers together, divide by 2. So effectively what's happening here in this one is, let me just pull that up, right? We take the total assets, let's see. Yeah, we've got beginning of the year is 8.45 million, 8.25 million, add them together, divide by 2. Net sales for the year is 4.175, and just note that the net income, we're not going to use that at all, right? There is your calculation. Effectively, what we're saying is for every dollar, net dollar that we have invested in these net fixed assets, we're producing 50 cents of revenue. Okay? So that's kind of one of those things where, again, internally that's important. Compared to your competitors, that's important. Compared to the industry, that's important. But again, remember, this is going to be very specific to that industry. We can't take, some little mom and pop drugstore and compare it to what Walmart's drug counter is doing, right? This one, we've got the following data were included in a recent Apple Incorporated annual report, right? We all know who Apple is. And their their fixed asset turnover ratio started out in 2020 at 7.4, went to 9.6, and then went to 9.7. So are they getting better or worse? Good. They're getting better. They're turning over their net fixed assets more often. So that's important to really appreciate there. And then here, Microsoft reported fixed asset turnover ratio of 3. So was Apple's turnover better or worse? It was definitely better. So look, Microsoft is at 3. Apple is at almost 2-3 times more.
Does it one to lower number mean it's better because it's 7 days instead of 9 days?
No. Remember, this is number of times that we're turning it over. So when you say turnover, remember that's number of times we're turning it over, and then we can convert it to days. Yep. Now, when we get to days, then the shorter the amount is better. Okay. All right. Then we've got preparing a classified balance sheet. They give you all kinds of assets and things here, and they just simply ask you to plug it into the balance sheet. So that's going to be another one of those things that is going to get a little tricky when you are looking at this information from this chapter, because we can't, this would be a monster problem, right, on an exam. Don't expect something like this, but we could give you this information, and then maybe we ask you, what's the total current assets from that group? What is the net property, plant, and equipment? What is total other assets? Something like that, where we could break it down into different pieces. Any questions there? The big thing here is also to remember is that when we're looking at all these accumulated depreciation numbers and things, everything has to be presented net of depreciation or net of amortization, and that depreciation and amortization accumulated has to be presented on the balance sheet as well. Any questions on that one? Okay. Let's see, what else do we have here on this one? Using Hasbro's 2021 net sales revenue and its average net fixed assets, calculate the fixed asset turnover ratio. Okay, so this one is 14.11. So again, like a little bit more than, or a little bit less than every month, so that's pretty good. Has the company generated more or less revenue from each dollar fixed assets in 2020 when its ratio was 12.55, and it was more revenue? So they're getting more efficient. So when you're looking at something like this, the higher that return is, the better efficiency they're getting. Let me give you an example of something like this. There is a really old hotel in Asheville called the Grove Park Inn. So I'm sure y'all have probably all heard about Biltmore House, right? Okay. All right. So the contractors and that built Biltmore House, after they were done with building Biltmore House, they actually went across town and they built the Grove Park. So this is, this hotel was built in like the very early 1900s. Very fancy hotel and everything. The same people owned this hotel for years and years and years and years and years until, I don't know, maybe 10 years ago, Omni bought the hotel. Now think about what just happened there. The old company had fully depreciated assets on their books. So when they were looking at these net asset turnover ratios, their net asset turnover ratio was very high. They were producing a lot of revenue based on fully depreciated assets. You with me? You got it? Okay. Then when Omni bought them out, you remember how it's going to go, how those assets are going to go on the book at Omni? At market price, right? So now we've got fully depreciated assets on the old company. Now on the new company, we've got nice big markups to market value. So now what is their asset turnover ratio looking like? Let's assume that they didn't change how much they were charging for the rooms. And same occupancy and the whole deal. What do you think happened? Or what would happen? That asset turnover ratio on the new company would go up or down? Good, down. Because now your denominator got hugely, you see where I'm going there? So you had really low fully depreciated assets. I mean, literally the company had been in business for, 50 plus years, right? So you have fully depreciated assets over here. Now they go on the books at Omni at market value. Now, what do you think happened to real world? What do you think happened to the price of a room at the Grove Park Inn after Omni bought them? Went way up. Okay? That's some of the things that we're looking at here in this particular chapter. Just an application of it. Okay? All right, let's see. So we got computing depreciation and book value for 2 years using alternative depreciation methods and interpreting the impact of the fixed asset turnover ratio. So we got Torge Company bought a machine for $65,000 cash. The estimated useful life was 5 years. Estimated residual value was $5,000. Assume that the estimated useful life in productive units is 150. Units actually produced were 40 in year 1 and 45 in year 2. So determine the appropriate amounts to complete the following schedule. So again, all they're asking you to do here is just calculate the different depreciation amounts based on the different methods. I'm hoping at this point, since we spent all of our time last time on that, you could knock that out pretty easily. Then it says, which method would result in the lowest net income for year 1? Well, if we want lowest net income, we want lowest expense. So year 1, the lowest would be straight line, $12,000. Oh, excuse me, lowest net income, we want highest depreciation expense, which would be double declining balance. I flipped it. Okay? Requirement 2B, which method would result in the lowest net income for year 2? Well, lowest net income for year 2, we want highest depreciation expense for year 2, so that would be 18,000 or the units of production. So all we're doing is we're filling out this table and then interpreting the table. Requirement 3, which method would result in the lowest fixed asset turnover ratio for year 1? So again, remember, when we want the lowest fixed asset turnover ratio, we either want a high numerator or a low denominator, okay? And in this particular case, that's knocks out with straight line. All right, go back and take a look at that one if you got any questions on that one. Let's see. Here we go, our natural resources, okay? So we've got Saskatchewan Forestry Company purchased a timber tract for $600,000 and estimates that it will be depleted evenly over its 10-year useful life with no residual value. Now again, remember, it's a timber tract. As we're cutting down the trees, the asset has less and less and less and less value, right? So when we figure out the depletion on this, so timber tract, $600,000, 10-year life, that's $60,000 per year. There's the amount that goes into our journal entry. We record it against accumulated depletion against the $600,000 timber tract asset. But notice what's different here. We cut those trees down and we move that cost into inventory, because now we're accumulating inventory costs to figure out when we sell that timber. Now we got to figure out a cost to go into cost of goods sold, and we got to figure out how much we need to charge for it for revenue. Make sense? So this occurs with timber, mining, coal, precious gems, silver, precious metals, rare earth metals. I mean, all those kinds of things work this way. All right. Oil. There's another one. So Texas Oil Company paid $3 million for an oil reserve estimated to hold 50,000 barrels of oil. Oil production is expected to be 10,000 barrels in year 1, 30 in year 2, 10 in year 3. TOC expects to begin selling barrels from its oil inventory in year 4. So notice what's happening there. We're pumping everything out in years 1, 2, and 3. We're not going to have any sales until year 4. That's the reason why they're actually putting this together the way that they are. So there's our oil reserve of $3 million. Remember, that's the asset that's on the books. The accumulated depletion increases each year, okay, for the amount that we pull out of the ground. There's our net, so our oil reserve net asset value is going down, and everything that we're pulling out of the ground goes into inventory for the oil. And if we had additional cost of people and equipment and everything else, all of that cost would go into inventory as well. Make sense? Yes. Okay, the accumulated depletion, right? We've got the oil inventory. So let's look at, let me pull up a calculator. All right, so we got $3 million, right, in the oil reserve asset. We then think that it's going to produce 50,000 barrels of oil. So there's 50,000. So this is working just like, boy, that just fell right out of my head. Your units of production, depreciation, okay? So 3 million, so $60 per barrel, right? So $60 per barrel. Year 1, we pulled out 30,000 barrels times 60. What did I just do? Hang on. 3 million. Oh, I think I dropped a 0. There we go. No. Oh, sorry, I picked up the wrong number. 10,000 barrels right here. I picked up 30. 10,000 barrels right there times $60 per barrel. There's your 600,000 that comes out of the asset into inventory. Then in the second year, it's 60 times the 30,000. So there's another 180. 1.8, excuse me. So the 1.8 million, right, plus the 600,000 that came out last year gets us to 2.4 in inventory. Then in the third year, we had another 10,000 barrels, so there's another 600. So 600 that we pulled out of the ground plus the 2.4 million gets us to 3 million. And effectively, what we're showing on the books here is that at the end of year 3, that oil reserve is empty. How we doing? Okay. All right. All right. This is another one that we have not talked about yet. So what do we do when we have a change in cost or estimated life? So again, remember that all of this is going into this whole concept of when we decide on the depreciation method, okay, we think that's going to be the depreciation method that we think is going to be most appropriate. And again, remember what's driving the choice of that depreciation method is matching that revenues and expenses. That goes all the way back to the matching principle in chapter 1. Okay? But if we decide that something is off or we've got to make a change to something, watch what happens here. So we've got Plummer Industries purchased a machine for $43,800 and is depreciating it with a straight line method over a life of 8 years using its residual value of $3,000. Okay? Now if I asked you to do that, you'd be like, not a problem. I got it. I hope. Okay? At the beginning of the 6th year, all right? Now be clear on what's happening here. We just finished depreciating it for 5 years. Okay? So at the beginning of the 6th year, an extraordinary repair was made costing $7,500. The estimated useful life was extended to 15 years. So now think about what just happened there. So initially, we thought that it was going to have a life of 8 years. We're total in 5 years, and now this repair has extended it to 15 or 10 more years. So we've got $7,500 investment into this asset, and now we've extended out the life another 10 years. So then it says calculate depreciation expense for year 6. Now, don't let this calculation scare you, okay? So what we start with is depreciation on years 1 through 5, right? Cost minus residual value times 1 over the useful life, or the, 40,800 divided by 8 years gives us $5,100 per year, all right? Then we're 5 years in at $5,100 per year. So we're saying that accumulated depreciation at the end of year 5 is $25,500. Okay? Then we calculate the book value. So the original cost plus the $7,500 in extraordinary repair, and go ahead and subtract the accumulated depreciation. So now effectively what we're doing here is we're calculating the current on the date that we made the repair and everything and put it back into service. We're using net book value as the acquisition cost, or as if it were the acquisition cost. So then look at what happens here. We take the net book value of $25,800, we subtract the residual value from it. Apparently that did not change. And then we divide it by the additional 10 years. So now, instead of depreciating it at $5,100 per year, we're only going to depreciate it at $2,280 per year. All right? So let's walk that through one more time. So on year 1, we calculated the depreciation of $5,100 per year. Each year for the next 5 years, we took $5,100 worth of depreciation for a total of $25,500. At the date of the extraordinary repair and putting it back into service, we calculate the net book value and use that as the acquisition cost. So now our net book value is $43,800. The net book value is 25.8. We take the 43.8, add the extraordinary repair, subtract the accumulated depreciation to get what we're going to use as if it were the new acquisition cost. Then we apply that same formula, the 25.8 minus the 3,000, so that's acquisition cost, think of it as that, as acquisition cost minus the residual value, but we're going to divide it by the remaining number of years. So the biggest thing here is the most common error that I see in something like this is somebody will look at this and they'll go, okay, well, we're 5 years in, we made the repair, and they extended the life to 15 years, and what they will do is they will take the 25.8 minus the 3,000 and divide by 15, because that's the new total life of the asset. And you forget that we're already 5 years in. So be careful on questions like this. Be absolutely sure that when you're picking up with the new improvement and moving forward, how many more years are we dealing with? Not how many total years are we dealing with. Okay? That is always the biggest mistake on a question like this. How we doing? So don't let all the math, don't let that scare you. Okay? Okay. All right. Here's another one with a change in estimate. So we've got Waiter Company operates a small manufacturing facility. January 1, 2024. An asset account for the company shows the following balances. So we got equipment and we got accumulated depreciation. During the first week of January of 24, the following cash expenditures were incurred for repairs and maintenance. All right, you know where it's going. 1, routine maintenance and repairs on the equipment. What do we do with that $1,850? Expense or capitalize? Good. Expense it. Repairs and maintenance. Then we've got a major overhaul of the equipment that improved efficiency. So what do we do with the $24,000? Capitalize it, right? So think about what we've got going on here. We've got this $160,000 asset. We had accumulated depreciation up to January 1. So remember, net book value before we did anything to it was 60. We now added another 24 to it, so now we've got an asset valued at 84, right? So we got an $84,000 asset. The equipment is being depreciated on a straight line basis over an estimated life of 15 years with a $10,000 estimated residual value. So the $84,000 minus 10, $74,000 in total remaining depreciation. Okay. Let's see. And we need they're going to make you work for it. All right, so the equipment is being depreciated on a straight line basis over an estimated life of 15 years with a $10,000 estimated residual value. So apparently we haven't made any changes unless they introduce it down here. Let's see. Yeah, the new depreciable cost is 84. We just did that. And the years remaining, I must be skipping over something. Hang on. Nope. They're going to make you work for it. So look what's happening here. So an estimated life of 15 years. So we got to actually go back and determine that the 160 minus the $10,000 estimated residual value, right? So the initial total depreciation over the life was going to be $150,000, right? Divided by 15 years, which would have been $10,000 per year, right? The fact that they've got $100,000 in accumulated depreciation tells you it's 10 years in, and we're still leaving it at 15 years. So there's our 5 years of additional depreciation. So we add, the only thing that happened here is we had the extraordinary repair. It didn't change the life of the asset, and it did not change the residual value. Okay, so now instead of $10,000 per year, we're going to have to depreciate it at $14,800. How we doing? That one they're going to make you work for a little bit harder, because you're going to have to figure out how many years in you are. See, I was expecting them to give it to us. All right. Oh, and that's it. Now, let me walk you through something else that's possible here. Because we haven't hit one of these, and I'm pretty sure there's one in your homework. So let's take this particular asset. So we're 10 years in. We do a $24,000 extraordinary repair. We've got new depreciable cost of $84,000. Okay. Now, then we take the 84 minus the residual value. So so here, the residual value didn't change. But what if the residual value changed? Let's say we do the extraordinary repair, and now the residual value goes up to 15. Or actually, let's do some nice round numbers. Let's say the residual value went up to 14. Make sense? So we did this extraordinary repair. Now, not only we'll say that the estimated useful life did not change, so we still have 5 years to go, but the residual value actually increased because we made this extraordinary repair. So now it would simply be, if the residual value went to 14, now we're only having to work with 70 in depreciable value. You see where I'm going? So when we make these extraordinary repairs, be ready, because one, the residual value could change. In none of these it did, but it could. So we have to apply the new residual value there. We have to figure out how far in are we, and then how many additional years remaining. So we could have a change in residual value and a change in the life expectancy of the asset. And you've got to take all that into account. So the biggest thing is, up to the point of where the extraordinary repair occurs, figure out net book value. Add the extraordinary repair, then figure out, now treat it like it's a new asset, that new amount, totally new asset. We apply the new possible residual value against it and apply it over the remaining years that we now have, whether that changed or not. Okay? It's a lot of math, but it's not hard math. The biggest thing is just make sure you get your logic correct. All right, how we doing? I know there's a lot to Chapter 9. Any questions on Chapter 9? Again, my other thing that I would recommend is go back to the slide deck, look or the book, and look at all those different categories of intangible assets and how long they're allocated and everything else. Because you could get some questions about, it's this kind of asset and what do we do with it, kind of thing. That's all I can think of at the moment for Chapter 9. All right, so if you can believe it, oh boy, how is this possible? We have 2 classes left. and the exam is next week. I won't take that personally. All right, so the exam is next week. Now, right now, I have the exam opening on Wednesday and closing on Friday. So everything in class has to be completed by midnight Friday. Okay? So when you walk in, let's see, hang on. Couple of things. One, if you have not, by next week, let's say it that way, by next week, if you're all good on your homeworks and everything else, remember, you can make whatever you want to on your Chapter 10 homework assignment. Because, maybe that will end up being your lowest dropped grade. Now, if you want to use it for practice and everything else for the exam, sure, absolutely do that. But if you've, nailed your homework all semester long, don't get bent out of shape if you don't have time to do your homework. You see where I'm going there? So this is all about strategy. Let's see. Just keep in mind this. Remember, if you do not open an assignment or do anything in it and hit the submit button, you cannot get into it later. So if you choose to go that route with not doing your Chapter 10 homework, at least open it so you can actually go back into it because it's due on Thursday. And if you want to, you're sitting there on Friday and you're thinking, okay, I'm going to knock out my exam today, and suddenly you're like, ooh, I want to go back and I want to check something on Chapter 10. If you haven't opened the Chapter 10 homework, there's nothing to open. It won't allow you to open an assignment that you didn't do anything in. Okay? So don't forget that part. Chapter 10. So let's walk it through. So where are we, right? We started off with the financial statements, right? We got all 4 sets of financial statements. We then backed all the way up and started analyzing transactions, right? We did daily transactions, we did adjustments, and then we did closing journal entries. That got it. So that was chapters 1 through 4. That got us all the way through the accounting cycle. Then in chapter 5, we started at the top of the asset side of the balance sheet, and we've been working our way down the asset side of the balance sheet on how we deal with all these different assets and everything. In chapter 10, we are now switching over to the liability side of the balance sheet. Okay? There's 2 big pieces to chapter 10. Okay? There's there's like this whole group of all these sort of like miscellaneous liability type issues. Most of them will be pretty familiar to you. The one that probably isn't is how do we deal with payroll on payday. Okay? Because whether you know it or not, if you've gotten a paycheck, right, you get that paycheck and there's FICA and Medicare and state tax and federal taxes, all that's coming out. In chapter 10, we learn how do we deal with those different things that we're withholding from people's paychecks, and we've got some additional costs that are incurred because of payday, like workers' compensation. There's another one, but it just fell right out of my head. That because we actually cut paychecks, that is what initiates the liability for workers' compensation, because at that point we can actually calculate how much we need to send in for workers' comp. So that's kind of one big piece of chapter 10. So it's all these miscellaneous little small things. And we'll talk about those on Monday. If we have extra time on Monday, we will move into the other big piece of chapter 10, which is bonds. Okay? Now, let me give you I got 5 minutes. Let me give you kind of a picture of this whole bond thing, because this whole bond issues and everything and how we deal with these, this is probably one of the more complex topics that we talk about in this class. And so let me give you a feel for it. Number one, think of it as you are the company. I am the investor. Okay? And you need to build a $500 million manufacturing facility. Okay? Now, for most companies, they're not going to just run down to Bank of America and go, hey, we need to borrow about $500 million to build our manufacturing facility. Bank of America's going to go, yeah, no. Okay? So instead of going to the bank, we go to the markets and we issue bonds to all these individual investors. Okay? Now, the assumption is each one of those bonds is $1,000. Okay? Face value. So the $1,000 face value is what you're telling me that I'm going to get back on the day that that bond matures. You with me? So if it's 10 years from now, then it will be what? 2035? Okay? So you're telling me what I'm going to get back in 2035, and it's $1,000. All right? Then the other element to this is, and this is where it starts to get a little funky, because it's like you basically have a triangle, and as each one of these things moves, it's like your triangle changes. Okay? So what happens is the other two pieces to this scenario is interest rates. Okay? So remember that the thing that I'm looking for as an investor is to maximize my return. Okay? So let's say that current market rates, and let's just ignore what's really going on in the market and let's just do some easy stuff. Let's say that current market rates for bonds are running about 5% in the whole entire market when we go out there and look at them. 5% is sort of the average. And you have to remember that all these bond issues take like 5 inches of paper, right? All these contracts and everything else that take attorneys and everything else months and months and months and months and months to put together. So when you decided on your interest rate, let's say that you were trying to predict what interest rates were going to do, but you decided on 4%. And now today, when you're getting ready to issue your bond, market rates are at 5. The amount that you're going to pay me is 4. You got it? How does your bond look to me? Good, bad? Why? Exactly, right? Remember, my sole focus is to maximize my investment. So you are only paying 4%. Everybody else is sort of looking good at 5%. So then how do you adjust for that to actually entice me to buy your bond? And effectively what happens is that you have to put it on sale or issue it for less than its face value. Does that make sense? So let's say something along the lines of, let's say that instead of, let's do it this way. If you chose 5% and the current market rate was at 5%, you would issue the bond at $1,000. So I would give you $1,000 today. You'd pay me 5% interest every year on that $1,000, or $50 a year, okay? And then in 10 years, you'd pay me back $1,000. You with me? So I give you $1,000. You pay me $50 per year over the next 10 years, and then you pay me back $1,000 at the end. Okay, that gives me 5% interest. Okay, but if now market rates are at 5, you chose 4%. Now what's happening is you've got to put it on sale. So maybe something along these lines. Now, instead of me giving you $1,000, maybe I only give you $900. But now you're only going to pay me $40 per year because you're paying 4%. But then at the end, you still have to pay me back $1,000. Make sense? Okay. Now let's flip it. Let's say that current market rates are at 5, but when you chose your interest rate to pay on your bond, you chose 6. How's your bond looking to me right now? Really good, right? Because if I go somewhere else, I'm only going to get 5%, but you're paying 6. But here's the cool thing. You know it. And I know it. So now, because you're paying more and everybody else's bonds are looking bad, now you charge me more like $1,100 for the bond. So now, in that case, I pay you $1,100 for the bond. You pay me $60 per year for the next 10 years. And then, at the end of 10 years, you pay me $1,000 back. How are we doing there? So effectively, what happens is this. One, we're constantly talking about the issuance of the bonds. How much are you going to get? Now, in this class, we're going to give you most every piece of information. In intermediate accounting, we start pulling out financial calculators and figuring out exactly how much we're going to charge for these bonds and things. So that's kind of where we're going there with this other big piece of Chapter 10. So you have to look at it. You've got, one, the things that are written in stone are you're paying me back $1,000, and you've told me how much you're going to pay me all along each year throughout the next 10 years. So maybe you were going to pay me 5%, so you were going to pay me $50 per year and $1,000 back. Or if it was 6%, you're going to pay me $60 per year and pay me $1,000 back. Those two things can't change when you're talking about bond issues. What can change, though, is how much the bonds are issued for. So if your bond rate is lower than market, you're going to have to put your bond on sale, and I'm going to buy it for less than $1,000. If your interest rate is paying more than market, I'm going to have to pay more like $1,100. Okay, but that issuance amount is what changes. That amount, that stated interest rate of how much you're going to pay me per year, can't change. That amount that you're paying me back $1,000 at the end can't change. Okay, that gets sort of a little funky when we start playing with it. All right, so that's Chapter 10. So when you're reading through some of that stuff, maybe that'll help sort of put it together a little bit. All right. Any questions? All right. Have a good one.